What are the principles of value investing? Imagine finding a hidden treasure in the stock market, stocks that are worth more than their current price. That's what value investing is all about. It's a way to buy stocks at a discount, hoping they will grow in value over time. If you want to be a smart investor, understanding these principles can help you make better choices. First, you need to understand what is called intrinsic value. Think of it as the real worth of a company based on how well it is doing. To figure this out, investors look at things like how much money the company owns, how much profit it makes, and how much cash it generates. This helps estimate what the stock should be worth if the market was fair. Next, the key idea is buying stocks that are priced lower than their intrinsic value. This is called buying below value. When you buy at a lower price, you create a safety net called a margin of safety. This cushion protects you if your estimate of the company's worth is a little off or if the company faces problems. It's like buying a product on sale, giving you more value for your money. To find these bargains, investors use simple tools called financial ratios. The price-to-earnings ratio compares how much people are paying for each dollar the company earns. A low ratio can mean the stock is cheap. The price-to-book ratio compares the stock price to what the company's assets are worth on paper. A low ratio suggests the stock might be undervalued. The dividend yield shows how much money the company pays back to shareholders each year. A higher yield can add extra income to your investment. Another principle is focusing on companies with strong fundamentals. This means looking for businesses that have good cash flow and not too much debt. Companies with less debt are safer because they don't have to spend a lot on interest payments. They can also invest more in growing their business. Value investing is not about quick wins. It's about patience and holding onto stocks for years until the market recognizes their true worth. This long-term view helps you avoid rushing into decisions based on short-term trends. Finally, do your own homework. Study the company's financial reports, industry, and business model. Don't just follow tips or what others say. Making informed choices is the best way to succeed. If you're a teen interested in investing, start by learning how to read financial statements and compare companies using ratios like price-to-earnings and price-to-book. Remember, investing is about patience, smart choices, and building good habits. Saving regularly and thinking long-term will help you become a better investor over time.